Alex, it seems like this earnings season, at least this week, has been a little wild. There's been a lot of boom and bust kind of reactions. But if you look on the surface, on the index level, it seems like a pretty standard pullback right now. But underneath the surface, a lot of growth stocks seeing a lot of motion this week. How have you been handling the current market?
Yeah, I agree with you, Ali. We had, well, basically the market, let's just put it in perspective. Let's start with the triple Qs. We had, the biggest first half since 1987, and this is in the top 10 since 1926. So it's about 40% move from year to date. And since the follow-through day that we had on May 10th, the triple Qs are up 15%. So as far as the stocks goes, earnings, it's a tough time. I always said it's more important the reaction versus what they say about the company. Meaning the earnings or the going forward guidance. It's the reaction. So you have, for instance, a few names that I can recall: ACL, LGM, I believe. Earnings were not bad.
ALGM.
Yeah, the earnings were not bad, but the reaction was horrible, right?
Yeah.
So that's what I mean by it. Just always pay attention to the reaction. So if, for instance, you have only stock before earnings, I would always, if you got a cushion of 8-10%, which is the minimum requirement in my view, just take half before earnings and see what happens with the other half. In this case, you would have been, probably losing money on that half. But at the end of the day, maybe get even, depends on what you got in. But for instance, I own Tesla, and I was ahead about 28% before earnings, but I still sold half the day of the earnings, as pretty much not at 299.29, but I sold at 294. And the other half, I still have it, and I'm looking at it right now and see how it handles around the 50-day. To add, I added a little bit last Friday, about 2%, and I'm looking at it right now. I haven't added any more, so I'm looking around these levels. But so far, right now, it looks like it's acting pretty well. So as long as we hold above the 10-week line or the 50-day, it's probably a good adding point. If you don't have any, you can start a little position. In my case, I already have a position, so I can rebuild that whole position that I had before earnings. So that's how I've been handling that. I can also give you, for instance, the top 5 leading stocks in the market since the follow-through day. For instance, MCI, which is super micro, year to date is 283%, but since the follow-through day on May 10th, it's up 139%. And this one, I mean, it's looking great. It hasn't given us any sell signals yet. In fact, if you look at the daily on this one, it's holding pretty, tight right there, up above the 10-day moving average. So on these names, I use more like the 10-day moving average as reducing positions because it's a little more volatile versus a large cap name like NVIDIA or MDB or Tesla. I will use a 50. But the other one is Uber. 81% year to date, 18% since the follow-through day, and it's at taking profits area, as you can see on your charts there. So, but it's holding so far barely above the 20-day moving average, but a little caution there. The other one is NVIDIA, which it's the second best stock in the market in my opinion right now. 211% for the year, 54% since follow-through day. Holding close to the 10-week moving average, and still not close to the 50-day. So this one, I'm still watching it. I missed it, so I played it with the SOXL, which is the triple leverage SMH. And since I couldn't, buy that one correctly, I bought this one, and pretty much the same return since the follow-through day. The other one is VRT. Up 159% year to date and 126% since follow-through day. This is a very, very powerful name. It's not as liquid as we would like it to trade it for us, but it's in the, I would say in the high octane category where you maybe have a little small position on that viable gap and use the low of that gap as your stop. And the last one is MDB, up 111% year to date and 54% since follow through day. And today is gapping up, hold it 10 or the 50-day moving average. And this is an earnings reaction, correct? Oh no, it's not due yet, but
I think maybe it's moving on Amazon.
right.
That's
So
right.
that's reaction on Amazon earnings. So this could be viewed as if you don't have it, you can maybe initiate here with the stop at today's low, and yesterday would have been better since it reversed. That's actually one of my favorite entry points, is when reverses off the key moving average of the, whether it's a 50 or the 20, and it closes at the top of the range. That's one of my favorite times to enter stock. And, you have now a nice little follow through on that. So it's not too late. So if you get here, you got to use today's low or the high of yesterday as your stop. So those are the top 5 ones that think are leaders. And like I said, the market looks fine. It will be healthy to have a little correction here. Typically in bull markets like this, for instance, you don't get much. Sometimes 2.5%, 3% on the S&P, and maybe 4 or 5% on the Nasdaq. Ideally, I like to see maybe more like a 7, 8% on the S&P to give us a little chance to review the leading stocks, see how they act and how they hold. But you don't get what you wish a lot of times in the market, mostly the time, I would say.
Yeah, exactly. Right. A great overview there. And also a great look at some of the leading stocks this year, and a couple of them like MongoDB, potentially Tesla as well, could be presenting actionable opportunities. So how do you reconcile the timing of seeing leading stocks that are setting up an actionable when you're expecting a continuation of a pullback? Does it just come down to having those stops and sell rules in place, and the error of commission versus the error of omission, not wanting to miss out on a buying opportunity? If you take that step back, look at the weekly chart, and we're in an overall uptrend. What are your thoughts on that?
Well, first of all, I always look at the weekly chart. It gives you the bigger picture and tunes out the noise of whatever's going, the short-term noise that a lot of times we get caught up into it. Before I enter a trade, I always say this, before you enter any trade to anybody, always know what you're going to get out in case it doesn't do all the wonderful things you wish it would do. Okay. So that's number 1 rule. So basically trading without rules, it's, gets yourself in trouble. And that's something I learned from O'Neill. He always said to me, you're going to get hit in this game. Just have rules, to exit, because that's the only way you're going to be, be able to trade the next day. So having said that, yes, make sure that you have a stop before mental stop or a hard stop, however you like it. And so, if I miss the leading stocks, a lot of times I tend to play them with ETF that has those names, and I use the leverage ones. So that's another way to play it through the back door. Like I said, I miss NVIDIA, I miss MCI. So I try to play them with a different vehicle that is more hedged, perhaps, such as an ETF, where, you're not going to wake up the next morning and your stock's going to be down 20%. Of course, if it's a leverage, you might be down 10%, but still not as bad as 20%. So that's a way to, the way I do it when I miss, which I have missed this year, a bunch of them. So I only had Tesla. I was on HUBS, and I sold it before earnings yesterday because I didn't have enough cushion. I only was up 3% from the buy. I bought it on that 497 shakeout, as you can see there at the end of the day. And so I wrote it, and yesterday before earnings, I just sold it. So I only made about 3%. So, it's pretty hard a lot of times. And you try to get on the leaders, but then you get earnings. And if you don't have enough cushion, you have to get out. and just wait and see. Even if you had to buy it higher, it's okay.
Right.
I don't want to see through a 10, 15, 20% drop, and then, it's hard to recover from that, not only financially, but mentally.